Hello, everybody. I'm Andrew Boudry.
And I'm Ryan Cummings.
Welcome to Your Bread and Butter podcast.
Today, we're discussing about the coming months, both the economic and the investment landscape, and how to navigate both of those.
See you soon.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer. Member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Private Financial Design LLC are not affiliated.
Bread and butter.
Hello, everybody. Welcome to Your Bread and Butter podcast. We're talking about the coming months, the economic and the investing landscape.
Yeah, the key points we're going to be looking at today is trying to figure out, well, what's going on economically, what's the kind of path that we're going through over the next couple months, and how is that going to impact your investment strategy? Where do you invest? How do you invest with kind of the volatile nature of the current economic landscape?
Exactly. So you're going to see that we have some things that are really affecting our economy that started off as maybe more of political enterprise, but they are having an economic impact. So first of all, inflation pressures are driven by the tariffs and rising production costs, which is due to a couple other factors as well.
Yes, we're looking at also labor shortages. So nearly 2 million immigrants being removed from the workforce, reducing it and reducing the output. And so we've even seen that actually recently with a lot of the recent labor statistics. I'll be very curious to actually see August's numbers. We just finished the month of August, and it'll usually take a couple days for those numbers to come out. But I mean, July, June, May, there was the whole snafu with the Bureau of Labor Statistics.
Oh,
and
boy.
The revision of those numbers down.
I don't know if there was a snafu, but...
Well, you know, the little bit of fit you could say that some people threw around the change of those numbers.
Yeah,
but that being said, they're all showing a weakening labor market.
Correct. And actually, you know, the idea of the job losses, it's expected in key industries such as solar, wind, education, healthcare. But the impact of immigration and the loss of these jobs, it is hurting the U.S. job market in a variety of ways, as well as our gross domestic product for our country. Economic growth is likely to slow down dramatically from where we were.
Yeah, I saw in a webinar I was listening to last week, I saw a good description of the job numbers and just kind of a logical, discussion around them of, well, it's maybe not so much that, at least the recent job numbers, that, we're seeing this huge reduction or like a recession in our labor force, but more so it could very easily be tied to a lot of the tariffs, the uncertainty that they provide. And even though a lot of the tariffs aren't actually enacted yet, still some are, but still many are not, the nervousness that causes business owners.
Right.
If you're a business owner trying to plan out, well, what are my expenses going to look like over the next year? Are these tariffs going to affect me? Are they not? Are you going to likely be hiring a whole bunch of new staff within your business? Probably not. And so we saw that directly reflected in a lot of the recent labor numbers since April.
Yeah, and a lot of these businesses, the smaller businesses, are getting affected by this. The big corporations aren't as affected by it, but the smaller corporations, smaller businesses are having a problem with it because they're losing the legal immigrants that were working for them, and because they're understaffed, they're actually having to close down their businesses, which that means 45, 50, 60 people are losing their jobs because they can't get enough employees to do the work. And so they're having to give it to larger companies, and hopefully those other people that are losing their jobs will be able to move on to some of those other businesses. So how does that affect you? I mean, this is time to invest, and it's time to save for your future. I mean, we dedicated our last episode to explaining who the Fed is, what they are, why they're doing what they do, and where they're going. And so now it's up to you to figure out how to save for the future.
Yeah, I think a lot of, even in times where we have some economic uncertainty, that's the tricky thing, is trying to figure out where we go next economic wise. Are we headed towards recession? Are we more just headed towards a little bit of volatility, but maybe some continued growth? It's a tough, even for the people who study it every single day, it's a tough path to map out.
Right.
And so I think regardless of when we're in these uncertain sort of times, you just need to hold true to a lot of the principles when it comes to saving and investing.
The basics. The
Right.
basics.
Right.
Control the expenses.
That's the big
look,
one.
Look at your checkbook. Keep the basic costs steady or lower where possible. Get rid of some of the streaming services that you only watch one show on. Yeah, okay, I know it's your favorite show and I get that. But, seriously, whatever you got to do to take care of, feed your family, build your emergency funds up. Ensure liquidity for your unexpected needs. And that's a really key part of just getting your own budget under control.
It is. And then once the basics, once that kind of spending and saving is, you've gotten a handle on that, well, now the investing comes in. And when it comes to investing, really all the time, but more importantly in
right now,
in kind of in volatile periods, you want to focus on quality, and focusing on strong quality companies, because in times of recessionary activity, which we may or may not be in, or even just in times where we're, like you even mentioning, we see businesses struggling with workforces. Well, the strong businesses, yeah, they might struggle, but they'll be all right. They'll be all right on the end, the other end of things.
Yeah.
The businesses that are maybe not quite as strong, they're going to struggle, and we could see them folding altogether. So when you're investing in these types of companies, you want to keep quality in mind. Strong, proven companies with long track records are going to be at least the primary component. It's maybe not the best sort of time to speculate on those unknown companies when you're looking at economic
We'll
uncertainty.
talk about speculation a little bit later, but for those of you out there who are like, well, I need more income, because I'm retired and I need more income. And with bonds being what they're going to be, with interest rates dropping, the interest rates on bonds are going to drop. So the older bonds that pay a higher interest rate, there'll be a capital gain there if you sell it. But if you're looking for higher income, look for dividend paying stocks that are really high quality, particularly in the preferred category, where, good quality companies paying a pretty good dividend, again, get good advice on it. We're not giving any specific stock recommendations, but income strategies don't always have to be bonds. It can be through the stock market. And then for those who are wanting to invest, look for contrarian opportunities. Look for those undervalued assets from really good companies instead of chasing after that, that rate of return. Oh, I heard this company's getting this. I'm just going to invest in that. By the time you invest in it, the run's already gone up and you're buying it probably at the peak, So I think that's really key. And last of all, diversification. Diversification is key.
Just the foundational principle to investing. Don't have all your eggs in one basket. Make sure you're spread across many asset classes, different sectors, geographical locations, not just U.S., for example. That proves true even so far this year with international markets. They've been beating the pants off the U.S. market as far as returns goes, and it's showing. And if you are diversified and not just all in the S&P 500, we've been talking about this with clients all year. Well, your returns are actually going to be doing better than just a pure U.S.-based portfolio, just due to that diversification.
And all you got to do is, if you're out there, you can Google how have international ex-United States, keeping United States stocks out of it, how are those international companies doing? I mean, look at the performance this year. Then look at the cyclical track record where the United States has beaten the international markets for 13.8 years, just say 14 years. Well, now we're going to get back to that cycle where the international markets could very well beat the United States market over the next several years. Don't know for sure, but it's something to have a bit of your money into right now. Have it there. Look for those good quality international companies that they may not be in the United States, but they're around the globe and they're still doing business. So, yeah.
And to that point, having a bit of your money in these different areas, I think there's even something to be said with the riskier assets too. Like I know we were just talking about trying to, maybe stay away from some of those, but we're talking about that for the bulk of the portfolio.
Right.
There still are your more speculative assets that do have a place in a portfolio, just at a smaller percentage. One of those being potentials for private equity. They're becoming now a potentially more mainstream piece of the U.S. market in the investing world, especially with some of the recent legislation around adding them into 401ks.
Right. And that can be risky too, because again, it's not a publicly held company. They don't sell shares on the stock exchange. So these are just private companies. We were just talking with a client recently who was looking to move into a residential community in one of the states, and they thought, it had been owned by the same family or business for a long period of time. Well, it's been around a long time, but it just recently, in 2017, sold to a private equity group, a private real estate holding group that owns it. And so, it's not mom and pop owning this anymore. It's a big private equity company. So in the private equity world, again, it's not a publicly held company. And so you don't have the transparency you do with a corporation that's on the stock exchange who has to disclose all of their financials, out there. So let's talk a little bit about, who really gets involved with private equities.
Typically, in the past at least, it's always been accredited investors. So they are certain income and asset, thresholds you got to meet. For income, it's like either $200,000 or $300,000, depending on your marital status, and you making sure that you have the assets to withstand the risk that comes with investing in private equity, because what some of the risks are, these companies are naturally, if they're not large enough to trade publicly, they're maybe smaller, newer companies. It could be startups. What if they go under? Or what if they need additional investments? These companies are allowed to call additional money and require that investors pay more if it's necessary to keep the business running. And so if you didn't meet these rules,
those are not fun phone calls.
No, not at all. And so, but in the past, you had to be an accredited investor to have the income, disposable income, to meet those calls and meet those investment thresholds. And so that world is kind of changing with the potential to add them to 401ks with the, we saw a lot of them at the conference we were just at, of the new mutual funds and ETFs that are, those are publicly traded ETFs that are invested in the privately traded equity companies.
Exactly. And I'm sure they're going to have limitations as to how much you can hold in your 401k,
Correct.
just as a guideline. And the next one here for emerging risks is digital assets, cryptocurrencies, and other digital investments. They remain volatile at this point because there's no real standardized way to look at it. But it's not just, Bitcoin and, Ether and all those. There's actually companies that are behind that are actually part of the whole thing. AI is another one that's out there. Everybody, I want to invest in AI. There's so many companies that are involved in the AI generation that's coming up. So you got to be careful about it.
There are, yeah. On the one note I want to spend on AI, we just we're talking with some individuals the other day about the AI space, and there's looking to be, not to say there is, I don't want to be the person trying to predict things because you never know, but there does seem to be some trending towards a bit of a bubble in the AI space.
Right.
Not necessarily a 2001.com bubble, but there are some similarities. There are lots of AI companies out there not generating profits. Now, while the big AI companies are likely to be okay, there are a lot of these small speculative, as we're on that topic, small speculative companies, these startups that, they're maybe throwing tons of money into this AI technology, but they just haven't figured out a way to generate that profit yet, which you go on too long about that as a small company, it's tough to last, not generating a profit.
Exactly. So you got to be careful when you're investing in something like that. But I do want to give you a really good investment for people out there. Do you know why a skateboard is a good investment?
Skateboard? Why?
There's a lot. Because you can flip it.
Oh, so a lot of liquidity there. Yeah. Okay.
Well, I got another one for you though.
Okay.
What do you call a gator who invests their money?
Gator who invests? I'm not sure.
An investigator.
Oh, okay.
Yeah.
Okay,
See,
there you go.
You gotta stay on top of these things.
Yeah.
Hey, first of all, you may not like the jokes, but you should like this next part. You need to know how to assess your risk.
You do. That's when it comes to any investment, whether it's the stable ones, the pillars of your portfolio, or the more risky investments, the speculative things we were just talking about. Understanding where you sit is key, because for some people, the biggest mistake that's made in investing is when things don't quite go positive, which we have periods of that all the time. They panic. They make irrational decisions, maybe pull out because they've lost too much. It's more than their blood can handle. And that's the spot where if your risk was assessed properly, you may not find yourself in those scenarios where you're tempted to pull out at the wrong time. So assessing it ahead of time with things like, looking at risk tolerance questionnaires, looking at your financial situation, stress test scenarios, all those sorts of things. We'll talk about some of these steps that you can use.
Yeah, we're going to look through that and kind of tear that down a little bit. I think that people across the board, 100% of the people are going to say, when you ask them about their risk assessment, they're going to say, I want to make a lot of money, but I don't want to lose any.
Right.
There's not really going to be anybody.
Those two things don't go hand in hand.
Right. Any opportunity that doesn't have risk is definitely going to pay less than the risk that you take on something else. So that's why a stock is more risky. You're an owner in a company when you buy a stock. When you buy a bond or you take out a CD, you are given a certain guarantee that you're going to get that amount of interest income on that particular product. When you buy a stock, you don't get that guarantee. But on the other hand, it's also likely stocks keep pace with inflation. Bonds and CDs they don't keep pace with inflation. So you get a risk reward with whatever you do. So let's look at the 3 dimensions of risk.
We have the emotional side of things. So this is how it makes you feel. With any financial decision, we talk about it with clients all the time. There's a balance between the hard numbers and the emotion, because you can make a decision that maybe on paper looks great, but as soon as you hit that emotional limit of, you can't take the losses anymore, or the money is not accessible, or whatever it might be, that may change your decision on that financial decision. So it's emotional. There's a straight financial side. So, do you have the ability to actually, from an income perspective, take that risk, like we were talking about with private equity? If you need to come up with extra funds, can you save and can it meet your goals? And then lastly, on the goals is, do these investments and their risk level align with your goals? A big piece of that is, for example, timeline. Say all the time, if you need money in a year, probably shouldn't be putting that in the stock market or in cryptocurrency or in some speculative investment, because you never know what could happen in that year's time. And while, yes, investing in some of those investments long-term can yield profits, short-term swings can derail your goals.
Yeah.
And so you need to base it off of the financial, the emotional, and the purpose, the reason you're investing in the first place.
My summary on that is emotions and money make a terrible partnership.
They do.
You can't let your emotions do it. And when a portfolio is down in value, it doesn't mean you've actually lost anything until you sell it.
Right.
And when you sell it, you own and you buy those losses. The same thing if you sell it when it's up, you buy those gains. Now, one of the things we've gone through here multiple times is we've shown people the beauty and the ability for money to grow of letting your money be invested and staying invested. And so we do look for managers when we manage portfolios, and we hire managers to be a part of a certain niche in that portfolio. We do trust them, and we've hired them for the client to do their job. And most of those managers, when they're switching assets out, they switch from one equity asset to the other asset. They're not usually out of the market too long. They're, moving assets to assets, so they don't want to miss out on those days in the market. So our job as advisors oftentimes is to help people to keep them from shooting themselves in the foot or worse. And so the idea is to let the market work through its own measurement. And then you, as the investor, let the market do its work. Anybody out there that says they're smarter than the stock market, run away from them, because there's nothing out there like that. And the market's, it's not its own animal. The market it's an entity, but it's influenced by so many factors. So on that note, let's look at how to use a risk tolerance questionnaire, how to understand how to use those.
When we were just discussing the emotional side of things, when looking at your, the risk dynamic in a portfolio, a risk tolerance questionnaire can be a good way to kind of get an actual quantitative hold on that emotional side. So it's a series of questions. We'll actually look at some in a few slides, give you an example of what this sort of questionnaire looks like. But it's a series of questions that explores, how you would react, what you would do in different scenarios, things like, scenarios when the market drops by large amounts, what's your time horizon. So it also looks at some of the actual core financial side of the reason you're investing, but then also explores those swings emotionally. How do you actually feel as an investor? Do you feel like someone who's more conservative? Do you feel like someone who's more aggressive? And it adds in those real life scenarios, because sometimes I've had it happen before. I've had clients who, will say in this sort of questionnaire, I feel like I want to be an aggressive investor. I want the high returns. But then you present a scenario that would happen to an aggressive investor, and they turn around and say, well, no, I don't want that. I wouldn't want those sort of losses. And two contradictory things. So it's a good way to kind of shed some light on, well, how do you think you are as an investor, but then how are you really as an investor in those various scenarios?
Yeah, and one of the things that people forget as they're planning their risk tolerance is that they might say they're conservative, they just don't want to lose any money, they don't care, what they gain, but 8-10 years down the road, when they really can't afford their lifestyle because their assets haven't kept pace with inflation, that's a very difficult and very, very unsettling conversation to have with people, that this is the portfolio you chose, and the reason why you have to cut back is because you really didn't want to invest more than that. And so oftentimes when we're working with people to assess their risk, a lot of people really don't know what their risk is, but they do know that 10 years from now they want to be able to do the things that they want to do.
It's about finding balance.
It's about finding that balance.
It is.
Currently as well as present. So
right, because to be honest, if it was up to me, with a lot of our clients, I really want to invest them really almost as aggressively as possible. I mean, and I think that you would agree. And it's just the dynamic of we're familiar with the history of investing, what the risks are involved and how time frames can help mitigate some of that risk. And, but not every client can handle that.
Right.
And
exactly.
So instead of just going with what the client wants all the time and being super conservative, or going with what we want and being super aggressive, it's, well, let's marry the two, find the medium where they're getting a healthy enough return, but not taking on too much risk that's above their threshold.
One of the ways to analyze your financial situation is to look at your time horizon. Longer timelines, they allow more risk. You're 60 years old, okay, you can retire in 8, 9 years, 7 years, whatever it is. Well, that's one time frame. You're 35 years old. Oh my goodness, that's a long time till that age. Somebody says, I'm 35, but I want to retire when I'm 45. Great, you got 10 years to climb that mountain. So you have to understand your time horizon as well. It allows for more risk the longer.
Yeah. I'd like to even give a couple examples.
Yeah.
When we look at, let's even just talk about some of the recent downturns in the market. We look at 2022. We had all the interest rate hikes. The market dropped 20-ish%, give or take.
Brutal.
About a year to recover from something like that. So again, the time horizon matters. We go back to 2020, the onset of the COVID pandemic. The market dropped 15-20%. 4 months, 6 months?
Actually, I think it dropped 30%.
Yeah, even still, so even more.
It took a while to get that back to balance.
A big drop, but it wasn't all that long. We were talking, a couple months. It was back by the summer, as far as the market recovery. And then if we go back even farther, all the way back to say 08, 09, the 40%, that we saw back in the financial crisis. We were only thinking, 2.5 years until the market recovered from something like that. Yeah. So, the point there is time horizon matters. You've got time. The losses, they're not great at the time when you experience them, but as long as you got a little bit of time to recover, the recovery happens, just a matter of when.
And you have to allow it to recover. Liquidity is important. Having short-term cash calls for a lower risk. If you have that need for right now, then you got to take a lower risk. And income stability and having your emergency funds. That's why you hear us talk about this all the time. If you have that, you can be a little bit more aggressive. And the best analogy I can give about this with investing is something that happened to me personally, where I would go out with one of my clients who was doing some yacht racing in Barrington, Rhode Island. And the second time I went out with him, there was a storm that day, bad thunderstorm, and weather cleared up, so we went out for the yacht race. And there was two of us I was the wheel guy with the rope, and I had another shipmate over there was doing the same thing, and we were strapped in pretty good. But all of a sudden, the storm reappeared back again. And I ended up in the water 3 times, pulling myself back in with my safety rope, and so did my shipmate. And so the result of that is I asked him. I said, "Why didn't we try to outrun the storm? Put up the sails and outrun the storm. Why did we put the sails down and just kind of ride it out?" He said, "Well, look in a storm like that, the wind goes one way, the water goes the other. You got to pull those sails down so that you don't get the boat ripped apart." And it made sense to me. And so he says, once it got better, we went to safe harbor. And I tell that story because it's real. Same thing's true for investing. Don't panic.
It is, right.
Just let, the market is at the backbone of everything we have in our country. So there's going to be a lot of efforts, just like 08 and 09, to salvage our banking and our financial system. And it will find a way to make sure that it works. It may not be as aggressive as you want it to be, but it will work. So let's talk a little bit about some stress test scenarios.
Yeah, so this is the last piece that something like a risk assessment can help with and give you some of those scenarios that can help you understand your true risk level. So it can be the extreme scenarios, the what ifs of what could happen to your portfolio. For example, if it dropped 25% tomorrow, would that be something that would cause you to stay invested? Would you sell? Would you panic? Would you call your advisor? What would you do in a scenario like that?
We hope you call your advisor.
Yes, that is definitely one of the recommended steps in that scenario. But another piece of that stress test is, how long could you delay your goals? That time, again, back to time frame. If the market underperformed, can you push back those goals? Are they flexible, or is it a hard deadline? Are you, an example, are you buying a home, later this year, or are you in the process of already potentially closing on one and you're planning on using some invested funds?
Whew.
Well,
get it out now.
You're already under contract. Probably not a good idea to keep that money in that home, buying fund.
Agreed. And I always try to explain to people that when the market falls like that, most of the portfolio managers, depending on their investment objective, what they're going to do is they're going to move out the assets that aren't going to recover the way that they should. And when the market falls like that, normally everything falls with it, but not everything recovers at the same time or the same speed.
Right.
So these managers are moving assets in and out, and that's where you trust these professional managers to do that. We don't do it ourselves. Now, if a manager's not performing, we'll pick up that manager and put somebody else in place. But they're moving assets around during that time period. So that's a good thing to remember. I think next of all, you got to revisit your profile regularly. You need to, you get married or you have children, home purchase, like you just said, pending retirement. You have to periodically stay aligned with your goals. And even though you see this vintage car or some fancy trip that you're going to have to go into debt for and all that, you got to look at your overall needs and review where you're at. And that's, again, we do that a lot with our clients who come in every 3 to 4 months. We visit with them. We talk about what their plans are, where they're going, because things change.
They do.
And
that's when your investment strategy may need to change as well. Just like you said, life events change, they happen, things go in a different direction, or time progresses and you get closer to those goals. And sometimes, when a goal was once 10 years out and now is only 5, well, your investment strategy changes a little bit.
When I was younger, my first investments were in camping and dolphins.
Okay.
Yeah, intense. It was for all intents and purposes. Porpoises, I'm sorry. But you have to understand...
That was a good one. I like that one.
You have to understand what you're investing in. You want to look at your goals, and if you're not investing properly, it's not going to work. We have a great risk sample up here, and you can go to Forbes Forbes.com, or just Google Forbes Investment Risk Assessment. It's a really good one.
We'll include the
it.
link in the description below the video, so you can always click on it and check out the full risk assessment. But we have here on the slide that you'll see just a couple examples of what you might see in an actual risk assessment. Things like, are you willing, just your own personal feeling, are you willing to accept above average risk when it comes to investments? Are you willing to hold an investment rather than sell it if it were to rebound within 12 months, even though it's lost value over the past year? So again, it's kind of that stress test question. How comfortable are you with investing? So your knowledge base, that plays a big role too, because oftentimes individuals with maybe a little more knowledge around the stock market, sometimes a little more comfortable with the risks involved rather than those who maybe it's something that's not their cup of tea, not their forte.
Yeah.
So there's that too. And then, other things just like how well informed are you on personal finance, and, would you consider investing in commodities or alternative investments?
Like investing in tea.
Yes. That is a commodity. Yeah, that fits right in that category.
It is. Well, I think as we go through this, the idea and the concept here is to really help you understand that controlling expenses, keeping your basic costs steady and lower where possible is going to be the major victory over this next year relating to personal economy.
It is just paying attention to those finances and those foundational pieces to your finance, and looking at income strategies, investing in those quality investments, and paying attention to those opportunities for investing. Looking at Investing 101, buy low, sell high. And
we say that to people about 401ks all the time.
Yeah.
And your 401k is a great opportunity. Buy what's out of favor. So in your 401k right now, I would be looking at a drop in the United States stock market, possibly over the next year. Who knows? Don't have a crystal ball there. We're looking at the international markets going up. So I wouldn't put new money into the international markets as far as like new dollars. Maybe you move a little bit of money in your 401k if it's a good international fund. But, you want to buy into the areas that might be on the downturn. And maybe that's the American growth stocks. I'm not sure where it is right now, but look for those buying opportunities for good quality companies.
Right. And then finally, just stay diversified.
Yeah.
Follow that principle of diversification. Don't be too much into one investment. Don't throw all your eggs in that one basket and hope that it hits, because don't get me wrong, if it hits, it can be great, but the risk return ratio that comes with that is often not worth it. So,
and careful for the advice that's out there on social media. There's all kinds of acclamations out there and proclamations and this, that, and the other thing. And just really be careful. Talk with people who are professionals. Both Ryan and myself are certified financial planners. You don't have to be a certified financial planner in order to give good investment advice, but we are fiduciaries. And so try to find people that are going to serve you in your best interest. Any other closing thoughts?
I think you hit the nail on the head. It's just if you're not capable of doing it yourself, there are plenty of people out there to help you with it.
Exactly. Well, we're really glad you listened and sat in with us today. And remember, live today for the tomorrow that's in your heart.
Because you'll never have more time to invest for tomorrow than you do today.
Thank you for listening.
Bread and butter.